Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Key questions here for the path of the dollar that we continue to ask ourselves. Long-term demand stimulus versus market deleveraging. And the private sector is deleveraging, getting rid of debt as fast as they can. But what's the public sector, our government side and the governments around the world? They're trying to pump as much debt back into the system as fast as they can to revive demand. And the reason it isn't working, even though we've seen a massive amount of money supply pumped into the system, is people are scared. And when people are scared, you can give them all kinds of money, make it available, they're not going to spend it. But the reality, too, is it's not been made available. There's a massive amount of excess reserves building up on the banking system in the U.S. and probably elsewhere, but the U.S. numbers are here for us to see. The banks are trying to heal themselves and not lending the money out. People that could take out loans aren't taking it. They don't want it, so they're not showing up to lend. Those that would want it, the banks aren't giving it to them. So you're seeing, in a very, very big way, that this demand stimulus that the government's trying to put into the system is being countered by market deleveraging from the institutional side and the private consumer side. And this is why we see the stimulus that normally would work in a normal cycle is changing in a very big way, and it's due to consumer savings, and I'll get to that. Next major question over the path of the dollar is, will the Chinese stimulus package work? And I'll get into some of the reasons why we're a little concerned that it won't. We think it's been front-end loaded, and we'll give you some numbers on that. And also, will we return to an implicit weak dollar policy? And let me explain that. Let me just go back to this chart earlier, and I think you'll maybe understand a little better. Let me go ahead and clear these annotations here and redraw this. This period right here, we've termed implicit weak dollar policy. Our government, for many, many years, has said, oh yeah, we have a strong dollar policy, we have a strong dollar policy, we have a strong dollar policy, blah, blah, blah. And the reason there was an implicit weak dollar policy, you have to keep in mind that the U.S. dollar is the world reserve currency. And the importance of that is because most all global commodities and most major global trade is priced in dollars. So people need dollars in order to buy stuff. So the dollar in and of itself is a driver of liquidity for all major asset classes around the world. And if you remember, as the dollar was going down, all the other major asset classes and those were going straight up, oil, gold, and again, I'll switch to that chart a little later. And the reason this is important is it just says the dollar is the funding tool for major asset classes globally. The dollar fuels the global economy. And as the dollar starts to strengthen for a lot of different reasons, or potentially different reasons, and in this case, the dollar is starting to strengthen because you're seeing that money, that U.S. dollar-based credit, recede from the global economy and roll back to the center and back to the U.S. As people need a hiding place, which just tells you that this implicit weak dollar policy. It's going to be hard to implement again in the future because people are not, again, going to stretch for these massive risk appetites that they had in the past. So even if the U.S. tries to weaken the dollar, and they may, the private sector may not be takers. But again, we have to be open to that. If the U.S. dollar is going to be the tool, it's back right in a major bear market, but we don't think it will for a lot of different reasons. And again, we'll get to those. Path of destruction. One of the reasons everybody is saving, and this may be a little bit old news, and I apologize if it is, but let me go through it because it's really important to understand, and this is part of the process. When we think of major global rebalancing, it means we're rebalancing the overconsumption in the West, and let's use the U.S. as the example, against the massive overproduction in the East, China, for example. The U.S. has a major current account deficit. China has a major current account surplus. China has major surplus reserves built up based on the fact that they exported everywhere, and U.S. has a major has to borrow from around the world to fund their consumption. that's changing in a very big way, and the reason it's changing is because of the U.S. consumer. Estimated $12 to $15 trillion of U.S. household wealth was lost between 2006 and 2008. Some say that's conservative and could be a lot more. When you lose that kind of wealth, you're scared, and you're going to start rebuilding your balance sheet, and you're not going to buy stuff. And if the U.S. consumer stops buying stuff, all those exports that were sent over here come to a screeching halt, and they have. That's the rebalancing. The U.S. consumer isn't buying. You look at the first 2 months of this year, and it's amazing. Imports to the U.S. have declined $108 billion in the first 2 months of the, it's actually, I think, a little more than that. I have the number here. Let me look at it. It's $108 billion during the first part of this year. First 2 months of this year, $109 billion. $30 billion of that was oil. That's a massive decline in imports to the U.S. Who takes the brunt of that? The U.S. doesn't buy, doesn't consume. The exporters from the East take that, those overproduction side. They get hammered, and that's why you're seeing, surprisingly, the Asian economy is getting hit a lot harder in this cycle in terms of their GDP and export growth than the U.S. is. This is a game of rebalancing that will hurt the exporters a lot more than it will hurt the importers in the U.S. And keep in mind why this is important in terms of the U.S. and the dollar relationship to Europe is Germany is the largest exporter in the world. And you're seeing Germany's growth fall off the table in a way that surprised a lot of the analysts. That's because they were an export-dominated model to a degree. Granted, they have a much more vibrant consumer model than any of the Asian countries. But the reason Germany's being hit so hard, and the reason this goes into the core of Europe, Germany is the driver of growth for all of Europe. German exposure is Euro exposure, and that's why, again, Germany's being hit harder here than the U.S. Consumers are not buying any longer, and we think this is a process of wealth building in terms of rebuilding the balance sheet that's going to go on for a while. Remember, in this cycle, the savings rate in the U.S. went down to negative 2% in the midst of this cycle. Right now, it's already surged to about 6%. When I say 6%, 6% of U.S. GDP. U.S. consumers are saving now. Most people think, or most analysts now believe, based on the trends, that we'll see a savings rate of 10% of GDP before this is through in the U.S. economy. That's a massive amount of money that no longer is going to be sent overseas to buy those imports coming in from Asia. It also means another thing. It means the U.S. savings rates, as it goes up, creates a massive pool of domestic capital in the U.S. That can be used to fund whatever the U.S. needs. Again, the government's spending, more than a drunken sailor, so I don't mean to imply that we're going to cover that. But from a relative standpoint, the U.S. private domestic savings rate increasing creates a pool of capital that tends to offset any pool of capital that we needed before coming in from overseas. And also, we're seeing our current account deficit improve in a very, very big way, very, very fast, which means we'll be less dependent on money coming in from overseas. And let me show you this, and I think this is a very important part of the equation. Again, this is when the last dollar bear market started, right in here, 2001, 2002. And we saw the current account deficit. This is the U.S. current account deficit increase. So this is the negative side. So deficit increased in a very, very big way, massively. This represents that funding of U.S. credit being spent around the world or being pushed out around the globe to fund asset classes. Sure enough, the credit crunch reared its ugly head right about here. And now we're seeing a massive improvement in the U.S. current account, which means we're not going to be as dependent on international capital flows as we were. And if we see this type of improvement, like $109 billion in the first 2 months of this year, in terms of U.S. imports declining, this can solve itself very, very quickly. And we happen to think that the U.S. current account is going to go positive before we're through in this cycle. I know that shocks people.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.